Good morning and welcome to Smart Stock Watch. It is March 3rd, 2026. Today, we are taking a close look at Belite Bio, a clinical stage biotech firm that just released its fourth quarter and full year 2025 results. Joining us to break down the numbers is John, senior analyst from Smart Stock Watch. John, Belite Bio seems to be at a major turning point. Give us the high-level view.
Thanks for having me. You're absolutely right. 2025 was a transformative year for Belite Bio. They are focused on unmet medical needs in the ophthalmology space, specifically Stargardt disease and geographic atrophy. Their lead drug, tinlarebant, is an oral therapy, which is a huge deal because most current treatments for retinal diseases require injections into the eye. The big news here is that they've moved from being just a hopeful clinical stage company to one with successful phase 3 data in hand.
Earnings performance versus analyst forecasts. Let's look at the bottom line. Analysts were forecasting a loss of 56 cents per share, based on a survey of 4 analysts. However, Belite reported a non-GAAP adjusted loss of only 38 cents per share. John, that's a significant beat on the earnings front. What drove that?
It is a notable beat. While the GAAP net loss was wider at $25.3 million for the quarter compared to $10.1 million a year ago, the non-GAAP figure, which strips out share-based compensation, shows a much leaner operation. The beat suggests that the company is managing its administrative costs effectively, even as it scales up for a potential commercial launch. It's important to remember that for a biotech at this stage, the loss is essentially an investment in their R&D pipeline, and coming in ahead of estimates gives investors confidence in their fiscal discipline.
Clinical breakthroughs, the DRAGON trial. The real story for investors, though, is the clinical progress. The phase 3 DRAGON trial results for tinlarebant in Stargardt disease were a highlight of the report. Can you walk us through those results?
This is the crown jewel of the report. The DRAGON trial met its primary efficacy endpoint, showing a 35.7% reduction in the growth rate of macular lesions compared to the placebo. In the world of Stargardt disease, where there is currently no approved treatment, a 35% reduction is clinically very meaningful. They achieved a p-value of 0.0033, which is statistically very strong. Because of this, they are on track to submit their new drug application, or NDA, to the FDA in the second quarter of 2026. If approved, tinlarebant could be the first ever treatment for this debilitating disease.
Operational expenses and pipeline expansion. With all this clinical activity, expenses are naturally rising. R&D expenses for the full year hit over $45 million. Where is that money going? And what else is in the pipeline?
The spending is very targeted. The increase in R&D is tied to the DRAGON 2 trial, which is focused on Japanese patients to facilitate a future Japanese NDA, and the Phoenix trial, which targets geographic atrophy, a much larger market than Stargardt. They've already enrolled 530 subjects in Phoenix. On the G&A side, the jump to $38.8 million was largely due to share-based compensation and professional fees as they prepare for the commercial phase. They are essentially building the infrastructure now so they can hit the ground running once they get regulatory approval.
Liquidity and capital strength. One of the most striking parts of the balance sheet is the cash position. They ended 2025 with a massive amount of liquidity. How does this change the risk profile for the stock?
It changes it significantly. They completed a $402 million underwritten public offering in the fourth quarter. Between cash and U.S. Treasury holdings, they have over $770 million. For a company with a non-GAAP annual net loss of about $38.7 million, this gives them an incredibly long runway. They aren't going to need to come back to the capital markets anytime soon. This war chest is intended to fund commercialization, which is extensive, and to continue expanding their pipeline into other metabolic diseases.
Key takeaways. John, it sounds like Belite Bio has checked all the boxes for 2025. To wrap up, what should investors be watching for in the coming months?
The big catalyst is the Q2 2026 NDA submission. Beyond that, watch for interim data from the Phoenix trial in geographic atrophy. Belite has transitioned from a high-risk clinical play to a well-capitalized company with validated phase 3 data. They are in a very strong position.
Excellent analysis, John. Thank you. And thank you all for watching Smart Stock Watch. Belite Bio is certainly a name to keep on your radar as we head toward that Q2 filing. What do you think about Belite's chances with the FDA? Let us know in the comments below. Don't forget to like, share, and subscribe for more deep dives into the latest earnings reports. We'll see you next time.